Let the recording start. I'm just waiting. Okay. So like all of you can just see the screen. Please just confirm me. Can you see the screen? Can all of you see the screen? Please confirm me. Hello.
Yes, sir.
Hello. Yeah, you can see the screen now. All
Yes,
of you.
sir.
Yes, let's go ahead. Yeah, yeah.
Yes, sir.
Yeah. So today's topic is property, plant and equipment. See, this property, plant and equipment are nothing but this is tangible assets. What is this? Tangible asset. Why we say property, plant and equipment are tangible assets? Why? Because these assets have physical substance. What do you mean by physical substance? We can touch them, we can physically touch them, we can see them, we can feel them. That's the reason why we say property, plant and equipment are tangible assets since they have physical substance. Okay. Now see, it is not easy for you to remember all these codes. If you study IFRS, International Financial Reporting Standards, there it is very easy to really know which standard deals with property, plant and equipment. There, International Accounting Standard 16, IAS 16 deals with property, plant and equipment. It's easy because they have easily the codification is very easy. Here the codification is not that easy and no need to remember these codes. Okay, just understand what the standard says. Fine. Next point. So property, plant and equipment include what? Property, plant and equipment includes what? These property, plant and equipment, also called fixed or capital assets, includes land, buildings and equipment. Okay, so these all come under property, plant and equipment. So why we say them as an asset? Why this property, plant and equipment is an asset for our business? Because we derive economic benefits from them. That is what is very much a requirement to to consider something as an asset. If you consider something as an asset, the basic requirement is definitely it should give you economic benefits, and the economic, since it's a tangible asset, we expect the economic benefits for a longer period of time, that is beyond a year. That's the reason why we categorize them as tangible assets or long-term assets. Okay. Or non-current assets. So whatever comes under non-current assets are the assets which give you economic benefits, not within a short span of time, but during a longer duration or longer tenor. That means more than a year. Okay, so if some asset gives you economic benefits less than a year, that is called as current asset. If some assets give you economic benefits more than a year, that is called as long term assets or non-current assets. Okay, and property, plant and equipment are non-current assets as we discussed. Now So now first of all, before starting this standard, I would like to explain you why you should study or why are you studying a particular accounting standard. See, we study a accounting standard because it guides you in a manner to understand more properly or in a better manner about that particular asset. Okay, so what does the accounting standard tell you, or what kind of guidance a accounting standard gives you? If you study this accounting standard which deals with property, plant and equipment, you really understand how to recognize something as a property, plant and equipment, how to recognize something as a property, plant or equipment. Okay, so recognition criteria. So what is the recognition criteria? Why are you saying that property, plant? Why are you saying that something like a plant or machinery or building is a tangible asset or comes under the category of property, plant and equipment? Since they have physical substance, they definitely give us economic benefits beyond a year or for a long time. And third point is they can be measured reliably. Okay. So the first and foremost thing is when you learn an accounting standard which deals with any of the elements of balance sheet or any of the elements of income statement. Okay. So there are standards which deals with various elements of balance sheet. Why? Because when you make a balance sheet, you write various things in a balance sheet. You write about current assets, you write about fixed assets or non-current assets. And non-current assets, again, I will divide into two parts. That is tangible assets and intangible assets. Okay, so when you write all these things in a balance sheet, those are called elements of balance sheet. So accounting standard tells you how to give an accounting treatment to these elements of balance sheet. So now I'll ask you a question. Why are you writing plant and machinery in the asset side of balance sheet? Please tell me. Why are you writing plant and machinery in the asset side of balance sheet? Anyone? You are writing plant and machinery in the asset side of balance sheet because it qualifies as an asset. Why? Because it satisfies with the definition of an asset. Am I right? Now, what is the definition of an asset? An asset is a resource which gives you economic benefits. Okay, economic benefits, and that which can be measured reliably. So any resource which gives you economic benefits. Now I'm not categorizing with less than a year or more than a year. I'm generalizing. I'm saying asset is a resource which gives you probable economic benefits. Okay, and which can be measured reliably. So if anything matches with this definition, that thing or that element should be shown in the asset side of balance sheet. Henceforth, since the property, plant and equipment or plant and machinery, which is nothing but a part of property, plant and equipment, matches with the definition of an asset, it should be shown in the asset side of balance sheet. That is the guidance which accounting standard gives you. That means if you read an accounting standard tells you how to recognize something in the income statement or balance sheet. Point number two. So recognition criteria is done. Point number two, as I said you, if you want to write something in the balance sheet, first it should match with the definition of an asset. If it matches with the definition of an asset, then definitely it qualifies as an asset and it should be shown in the asset side of balance sheet. Point number two is, it is not only that you are going to write something in the asset side of balance sheet for the sake of writing. You should write the value of that also. Am I right? For example, if I write plant and machinery, is it all right? Like, is it like fulfilling the task? No. Plant and machinery is a tangible asset. Henceforth, it should be written in the asset side of balance sheet. The next criteria is there should be some value which should be written in the asset side of balance sheet to let us know what is how much worth is this plant and machinery. Am I right or wrong? Please tell me yes or no, all of you in chorus. Yes.
Yeah.
Hello. All of
Yes,
you,
sir.
are you understanding? Are you following what I'm saying? Hello. Yes, 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 yes. So the first and foremost thing is if you are writing something in the asset side of balance sheet, firstly, it should be matching with the definition of an asset. It is not the complete thing what you're writing there, because if you write something like plant and machinery and just put it like that, this is not writing that completely. What would complete it if you write the value of that also? Okay, so that is nothing but the measurement basis. There comes measurement basis. That means you will be writing plant and machinery in the asset side of balance sheet, and you should also show what is the value of that plant and machinery in the asset side of balance sheet. Now I will come to the next point, at what values you can show it in your asset side of balance sheet. Okay, so the second criteria what a standard guides you is measurement basis. So I'll put it neatly. Fine. So accounting standard. The first point is recognition criteria. You recognize something as an asset if it satisfies with the definition of an asset. And I've already explained you the definition of an asset. So this is a balance sheet. I would write property, plant and equipment in this. Why? Because it is matching with the definition of an asset. Point number two, this is not a complete recording of something in the balance sheet, because whatever you're recording definitely should have some value, or only something which can be measured in terms of money, can be recorded in the books of accounts. So now comes the measurement basis. That means some value of this should be shown. Okay. Now third point is disclosure requirements. So I would now elaborate on these 3 points. Now property, plant and equipment. Why I am writing in the asset side of balance sheet? Because it is matching with the definition of an asset. So my recognition criteria is done. So I am writing those 2 points here, matches with the definition of asset. Since it matches with the definition of an asset, we write that in the asset side of balance sheet, and it should be measured reliably. Now, what is this measured reliably? See, we have 4 employees working in our company. So names are Ramesh, Hitesh, Suresh, Jignesh. So all these A's are working in our company. Can I show Ramesh as 10 crores? Can I show Hitesh as 5 crores? Can I show Suresh in my books of accounts or balance sheet as 50 crores? Can I show Jignesh as 1 lakh? Can I show them like that? No, I cannot show them. Why? Because these are human beings, and human beings don't have a value. Am I right? Can someone buy a human being here? There's no slavery in this current period. Am I right? So in olden days, people used to buy, like Americans used to come to Africa and used to buy Africans and take them as, and they used to enslave them. Now those things are not going on. Ramesh, Hitesh, Suresh, Jignesh can be paid for their services, but not for but their value, but they cannot be valued because human beings are invaluable. Am I right? So something which cannot be measured reliably cannot be written in the assets side of balance sheet. That means if something is of non-monetary nature or something which cannot be measured in terms of money, that has no place in books of accounts. So the first point, the recognition criteria is very well understood. I think you have understood what is the recognition criteria. Am I right? All of you, yes?
Yes, yes.
Yes. So property, plant and equipment I'm writing in the asset side of balance sheet. Why? Because it matches with the definition of an asset and it can be measured reliably. Now the second point is measurement basis. Now there should be some value for this. Am I right? Something 1 lakh, 10 lakh, 5 lakh, something. So the value, how the value gets created or how would you measure a particular asset? Either at historical cost or at fair market value. Okay. So what is this historical cost or what is the fair market value? See, when you buy a asset or when you construct a asset, you would definitely know what cost you have incurred to either buy it or to construct it. So that is nothing but the historical cost. That is nothing but the value of that asset. Am I right? Either you can write the asset in the asset side of balance sheet at historical cost, or another way of writing an asset in the asset side of balance sheet is at fair market value. So fair market value is nothing but what, so we would say this historical cost as book value. Okay, I would come to some other points in the coming like pages. Okay, and then fair market value is nothing but if you go and if you sell that particular asset in the market, what are the market participants ready to pay you? Okay, so that is nothing but the fair market value. Generally, a asset can be shown at historical cost or can be shown at fair market value. It's upon you. It's your wish. Okay. The standard supports you in both the cases. What see if you showed historical cost after 10 years or 20 years, that doesn't look realistic. Fair market value is nothing but the market value of an asset changes based upon its demand in the market. See, you would have seen some properties people have bought 20 years back in some prime areas in Hyderabad for some 1 lakh or 2 lakhs, and they are ready to sell those properties at 1 crore, 1.5 crore. Why? Because of the market value. The market value of that asset has gone up because of a very high demand of that asset in that particular market, because of non-availability of such assets in that market. Okay, so you can write at fair market value because it looks more realistic. But the standard says they are not forcing you to follow any of them particularly. They are okay with any of the ways you want to record that asset or record the value of that asset in the asset side of balance sheet. Okay. Now point number 3. Disclosure requirements. See, you have written property, plant and equipment and the value of that. Fine. And usual practice is if I have bought an asset today, for example, on 1st Jan, for example, I bought an asset and December 31st is the end of the year. So 1st Jan 2022 is the starting is the starting, and December 31st 2022 would be the end of the year. So you know that asset which I have shown in the asset side of balance sheet have to be depreciated. Am I right? So every year you would be depreciating the asset and you would be writing the book value. Okay, the revised book value every year. The book value would revise every year or not based upon the depreciation deduction every year from the asset. Please tell me yes or no. Yes. Hello. Everyone is following.
Yeah.
Yeah. So would you be deducting the depreciation every year from the asset value?
Yeah.
Yes. 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 So like in IFRS, we say it as carrying amount in IFRS as per the reporting standards, International Financial Reporting Standards. We say it as carrying amount. Carrying amount is nothing but original historical cost minus accumulated depreciation. Here we say book value. It is also the same thing. Historical cost less accumulated depreciation. Okay. Now what is this accumulated depreciation? See, every company depreciates its asset at the end of the year. Am I right? So this practice is regularly followed every year. So what they do is they create an account called accumulated depreciation account. This is nothing but a contra asset account. What is this? Contra asset account. Why this is a contra asset account? Because it reduces the value of an asset. Okay, every year it reduces the value of an asset. So how the practice goes is, suppose the asset is of 1 lakh and there are two methods which you can use in the US GAAP for depreciating an asset. So I'm also naming them. The methods are nothing but straight line method and double declining method, not diminishing balance method. Please understand, in IFRS, I'm also in contrast to US GAAP. I'm explaining you what methods you can use in IFRS, because I know you're not learning IFRS, but in various instances or like in pages, you would be seeing every point of time these two standards are compared. Okay, so in IFRS you use straight line method as well as diminishing balance method. Okay, these are the two methods you use, and in US GAAP you use straight line method, double declining method, sum of the years digit method. I will be explaining you all these methods very shortly. And one more method which comes into picture is some of the years digit method, and they also use yeah, I think these are the methods what they use in general. Yeah, here straight line method and diminishing balance here. Okay, and for tax purposes, see, you prepare books of accounts, am I right? You prepare the accounting, you prepare the financial reports at the end of the year, okay, based upon accounting standards, and you prepare tax returns based upon tax codes or tax rules. And here the method what you use for depreciating an asset is MACRS method. If I'm not wrong, in the chapter called investment decisions, I have explained this method clearly to you. Am I right? Yes.
Yeah.
Yeah. I modified accelerated MARCS or MACRS, something like that. Just a second. Let me check it out. This is the method. MACRS method, modified acceleration. This is given by the IRS, Internal Revenue Service. That is the authority which deals with the tax system in United States. I think modified accelerated cost recovery method or system, something like that. That method is all about. OK, so this method you will be using for tax purposes, or when you file a tax return, you would be using MACRS method for depreciating an asset to find out the tax base of an asset. What do you mean by tax base of an asset? See, if you show assets in the asset side of balance sheet, that is shown at book value. Am I right? That is called book value. When you show assets in the asset side of balance sheet, when you prepare tax returns, income tax returns, when you file income tax returns, you prepare a balance sheet there also. So the asset what you show in the income tax returns, that is in the balance sheet of income tax returns, that is called as tax base of an asset. Okay. Now I was into the methods what we are using, and yeah, I was into the accumulated depreciation account. Let me finish that part, then things will become very easy for you to understand. Now, yeah, I was saying you something. Accumulated depreciation. Okay, so let me come to my example once again and explain you the concept. So my asset happens to be of 1 lakh. On Jan 1st, I have purchased this asset. Now I need to depreciate this. So I'm using straight line method for that. OK, so what would happen is my depreciation is at the rate of 10%. So my journal entry would be depreciation account debit to accumulated depreciation account. OK, I'm not using asset account here. Please understand what I'm saying. So this 10,000 goes into the accumulated depreciation account for the first year. And here is the asset side of balance sheet. Here we have the property, plant and equipment of 1 lakh, the asset, whatever I have. And here we directly deduct the accumulated depreciation. OK, 10,000 and we have the asset value 90,000. Okay. And in the statement of profit or loss, whatever we are preparing, we are writing this particular depreciation as an expense. Okay. That means we are debiting this depreciation in the P&L account. How would we write the entry? First, the depreciation is transferred to this account. Okay. And also debited in the P&L account. So the entry would be profit and loss account debit to depreciation. Correct? Please tell me yes or no. Hello, all of you.
Correct only,
Yes.
sir.
Yeah. No, I'm not asking correct or wrong. I'm asking are you following or not? Okay. I know it's correct. So fine. So this is what is the treatment you would make. And next year, what would happen the second year? Second year again, depreciation account debit 10,000. Okay. Goes to the accumulated depreciation account. And this 10,000 and again more 10,000 comes into picture. So that becomes 20,000. Okay. So this is a regular practice. It happens. So 20,000 would be deducted here and the asset would be written as 80,000 in the second year. Okay. Fine. So first year we transferred it and showed in the P&L as an expense. Second year we again transferred the 10,000 to accumulated depreciation account and now the accumulated depreciation is 20,000. That would be deducted from the asset value in the second year and the asset value or the book value is now 80,000. And in SOPL or statement of profit or loss, we still write depreciation as 10,000. Okay. So depreciation accumulation is shown in this account, but every year's depreciation is shown in the P&L account as 10,000 as an expense. So that is a treatment. Now, so now here you can see a lot of things we have discussed. Initial recording of the asset. So how would you record the asset initially? Historical cost. Am I right? So fixed asset should be initially recorded in the accounting records at historical cost, which is the amount paid for the asset and all other costs necessary to get the asset ready for use. For example, I bought the asset for 1 lakh. Excuse me. Yeah, sorry, I just got a call. So we would show the historical cost. Yeah, so suppose I bought an asset for 1 lakh and this is not the only thing which I'm going to spend for that asset. Maybe some expenses I would incur to bring this asset from the factory or from the supplier's place to my factory. So I'm incurring some freight charges of 10,000. Suppose I'm bringing it from some other country, so import duty. So these are all the direct expenses, directly attributable expenses to bring asset from one place to our factory premise. OK, and then after getting this here, I have asked some engineers to come and do the installation thing. So installation expenses, all these are direct expenses. And now the asset is costing me 1,30,000, because whenever I will sell this asset, I would recover this extra amount also, whatever I have incurred with the asset. Am I right? So these are all the expenses which like I have spent to bring the asset from the supplier of the asset or the manufacturer of the asset to my factory, and also spend some expenses to make it ready for use. OK, so this is what is the meaning of this statement. Now they have given some examples of the tangible assets, buildings, machinery and equipment, or any kind of improvements you do to the asset. You add it, land, and one thing with land is land definitely never depreciates. OK, why? Because there is no expiry date for land. So something which doesn't have expiry date never depreciates. That's what. Now I would like to ask a question to you. I would like to ask a question to you. Building. So this building I have purchased from XYZ. OK, and I've spent 1 lakh for this. Is this an expense, or is this building an expense for me or an asset for me? Please tell me. My question. Please.
Building is an asset.
Building as an asset. Yeah. Why it is an asset? Because you are saying that it satisfies with the definition of an asset, and it can be shown in the assets at a balance sheet. I understand. And it can be measured reliably. That also I understand. But I have also spent money for that, na? And money has gone from my account. So whenever I spend money, it is an expense also for me. So what is that then? Why, like, I am not showing this building as an expense and I'm showing it as an asset? Any clue? Yes. So what? Any idea? See, the building, whatever we are purchasing only once. That too, when we are starting our business activity. OK, so we are purchasing at the inception. That's it. And secondly, whatever you spend only once. I know, I understand we have spent money for this, but the money we are not spending on daily basis on the building. Whatever would be spending on daily basis on the building would be servicing, service charges, servicing or maintenance charges. Maintenance charges, building maintenance charges. So building maintenance charges is definitely an expense for the business. Why? Because it is a revenue nature expense. Why it's a revenue nature expense? Because we spend the maintenance charges on routine basis, on recurring basis, regular basis. Am I right? But are you purchasing building on regular basis, routine basis? Please tell me. You purchase it only once, that too when you start the business activity. So it has to be capitalized. What it should be done? Please tell me, what is this word?
Capitalized.
Capitalized. So here I am writing building. Acha, in case inventory, you bought 100 boxes. So this 100 boxes is, see, this is Mr. XYZ and he has bought 100 boxes of inventory. He deals with let's say like soap boxes. So he has a departmental store. He sells soaps. Okay. So he has bought 100 boxes from a supplier. My question is, this 100 boxes, whatever he has bought from the supplier, is it an asset or an expense? Please tell me, any one of you. Zarina? Yes, brother Jabbar? Smriti?
Expense. Probably.
Zarina, I'm not hearing your voice. Yes. My question is, XYZ has bought 100 boxes from a supplier. Okay. And he deals with these boxes. He sells them on routine or daily basis. So what he shall treat these 100 boxes as, since it's an expense for him, it is definitely there. It is an expense for them, expense for him. Will he treat them as an expense or an asset? What shall he do?
Expense, sir.
Expense. Why not asset? If it is expense, and if it is asset, then why not expense? I want the answer for that. See, very clear.
It is an expense because keeps buying it on regular basis, but also sells it.
No, he buys on regular basis also. Now, see, I'll tell the answer. And with that, I'll try to explain you the building concept also. See what happens. These 100 boxes, whatever this XYZ, the retailers bringing from supplier or retailers buying from supplier, these 100 boxes are asset for him. Why asset? Because he is yet to sell them. So this will give him future economic benefits. Am I right? These would give him future economic benefits or not?
Yes.
Correct. This will give him future economic benefits.
Sir.
So that is why I am saying that it is an asset. And you said, sir, he buys them at once. Yes, he would buy one lot at once. Now what he would do is, on Jan 1st, I'll make it neatly. On Jan 1st, the supplier has bought 100 boxes. So it is an asset for him, of course. Okay. Now on Jan 2nd, he got a customer to whom he sold 20 boxes. So he will show this 20 boxes revenue. Am I right? He will show or not?
He will show.
And for these 20 boxes, whatever revenue he is earning, definitely he should have spent some cost for that revenue earning. Without spending money, you cannot earn revenue. Matching concept comes into picture. So he has to show the cost of these 20 boxes, which he will show in the COGS. Correct? Please tell me yes or no.
Yeah.
And then he would get the profit for those 20 boxes. Okay. And the rest leftover 80 boxes are still what for him?
Assets
Nothing but the closing inventory, isn't it so?
Yes, sir.
That is the reason what I'm saying. When he buys or purchases 100 boxes, it is an asset for him and he has to capitalize them. He has to capitalize it. With capitalize, when I say this term capitalize, I mean he should record them in the asset side of balance sheet. So whenever I use this word capitalized, I mean that it should be shown in the asset side or this should be shown in the balance sheet. That is the meaning of capitalized. Now what he has to expense, 100 boxes when he bought, he capitalized it. And that means he has shown them as asset. That means in the balance sheet, he has written inventory, 100 boxes of some value. Now from that, he has withdrawn 20 boxes. Next day, he will be recognizing these 20 boxes under COGS as purchases, because for every sales, definitely there should be a purchase. Am I right? If he's selling 1 unit, definitely he would have purchased that 1 unit. If he's selling that 1 unit for 100 rupees, definitely he would have purchased that 1 unit for 80 rupees. And then 20 rupees is what he's going to earn the profit. Am I right? So the 20 boxes would be expensed. Okay. The 20 boxes would be expensed because he is generating revenue out of them and he has to show the expense also. And the 80 boxes which are left over are still in the balance sheet, capitalized. In the same way, the building which you buy at the beginning of the year, that means building generally is not bought every year. It is bought at the inception or while starting the business. So it has to be capitalized. And any expenditure what you incur on this building on routine or regular basis should be expensed. That means shown in the P&L account. Okay. So these two things you should understand. So whichever asset a business buys, they always capitalize it. Okay. And whatever the expenditure they incur on them subsequently or in the coming years, they always expense them or show in the P&L account. Okay. Please tell me, are you fine with this? Now I would give you a statement here to understand in a more better way. So now I will tell you, I bought a building of 1 lakh rupees for my business. Okay. So what shall I do for this, Smriti? I shall capitalize or expense? Smriti, I should capitalize or expense?
Capitalize.
Capitalize. That means I should write it definitely directly in the asset side of balance sheet, correct or wrong?
Yes, sir.
Now, how will I expense it? In the coming years, building definitely would be depreciated. So what I will do is every year 10% of this, which is 10,000, I would be expensing. Am I right? See what happens. You should understand the concept generally. See, I bought a building of 1 lakh. Why did I bring this building? Why did I bring this building? I bought this building for my business purpose. To earn profits for my business, I purchased this building. I would be using this for selling goods or whatever means. That is, I would be purely using this building for my business revenues or generating revenues for my business. Either I can use this as my I can use this building as a shop or a go down or whatever you want, you can say, or a head office, branch office, whatever you want, you can say. So this building which I bought for 1 lakh, I have bought it for my business. This building I'm using for generating my revenues, correct? Somewhere or the other, this has a contribution towards revenue generation. Please tell me yes or no. Somewhere or the other, this building I'm using for generating my revenue.
Yes, sir.
Yeah. And this has a contribution in generating revenues for my business. Yes. So I would show a revenue here.
Yes, sir.
I would be showing some revenue in my income statement. And since the building I'm using for generating revenue, okay, for every penny, whatever I'm generating as a revenue, I definitely would have spent some cost to generate revenue. Isn't it so? See, without spending money or without like incurring some cost, can you generate revenue for your business? Come on, tell me. No. So somewhere or the other, the depreciation of this building would be the expenditure I would be matching with my revenue. Am I right? So that's the reason why when I purchase the building, I capitalize it. I show in the asset side of balance sheet. And in the coming years, every year I would be expensing this building via depreciation. I would be expensing this building via depreciation in the statement of profit or loss account. That means I would be matching the depreciation with the revenue of my business. Okay, that would be a correct treatment. You got my point or not? All of you, please tell me. Zarina, like Smriti and Jabbar, did you get my point? What I'm saying?
Yeah.
Jabbar, you got this?
Yes.
Please tell me if you did not understand. If it is very complicated, I will make it easy for you. I'm saying I'm using this building. Okay. I bought this building, and when I bought it, this is definitely an asset for my business. So I capitalized it. Okay. So when I capitalized it, now I have to expense it. And this building I'm using for what purpose? For generating revenue for my business. And whenever I earn revenue for my business, definitely the revenue won't come without spending money or without expending. Without incurring some cost, you cannot generate revenue. That is unnatural for any business. So to generate sales for your business, you have purchased the building. Okay. I have purchased a building and I'm using it as my shop premise. That means I have spent money, and with this in this shop premise, I'm putting all my stock and inventory. I'm keeping all this and I'm selling to my customers. I'm generating revenue. So that revenue has to be matched with what? With the expenditure, whatever I am incurring. Okay. So the capital expenditure, whatever I have incurred, is building, which I have shown in the balance sheet. But every year, with the passage of time, the building would get depreciated because it's because of continuous usage of that building. It would definitely get depreciated with the passage of time. So that expenditure now I have to show. I will show in the P&L. Why? Because somewhere or the other, this building has a contribution towards earning revenue for my business. And for the revenue, whatever I'm earning, all the expenditures I should match with that revenue to get my net profit. So that's the reason why I expend this building every year and show it in the P&L account via depreciation expense. Okay. So the last concluding point is building, whatever you are capitalizing in the asset side of balance sheet, you're expensing that via depreciation in the P&L account. Okay. That's it. So now we are into the next topic, depreciation. And you can read this point. Depreciation is the systematic and rational allocation of cost of a fixed asset over its expected useful life. In other words, depreciation matches the cost of acquiring the asset with the revenues the asset will generate over its useful life by spreading the recognition of the acquisition cost over the period time during which the asset will be useful. So instead of reading all these points, I have made this point very clear to you with the help of an example. Correct? Now, what is this net book value of asset? See, when you purchase the asset for 1 lakh rupees, that was called as gross book value. What was that called? Gross book value. Gross book value minus accumulated depreciation would give you net book value. Okay, that's it. So here in our case, this is gross book value. This is accumulated depreciation. They did not mention for how many years or what. They have just put a figure here. So 76,250 is nothing but the net book value of the asset. Okay. Now let's go into the next topic, calculation of depreciation. So as I told you, in US GAAP, you would be using straight line method and double declining method. And the next point is you would be using sum of the years digit method. And one more method they would be using. I'll be coming across that. See, depreciation can be used in different perspective for different kind of assets. If you have a machine, if you're using machine, this machine can be depreciated based upon straight line method or based upon some other methods also. There is a method called machine R method. I don't know whether you have an idea or not. If you don't have, I will give you an idea. Let me move forward, then I would come across this machine R method. Then if you have a coal mine, or if you like are into a mining business, and you definitely show these mines in your asset side of balance sheet, and you know mines, every year you would be extracting minerals from those mines. So the after extracting the minerals, the mine would get depleted, correct? So there is a depletion method for that. Depletion method of depreciation. Okay. So all these things are not there for you, but when it comes, I will be explaining you clearly. Okay. So these are the terminologies what you're going to come across when you calculate depreciation. Estimated useful life. See, any asset which you purchase, suppose you have purchased a building. So you would be estimating that you would be using the building for some 10 years. So can I say this is the estimated useful life? Yes. Estimated salvage value. That means you would also doing an estimation. Estimation is nothing but beforehand you kind of make some forecast. That is called estimation. So your forecast is that you are going to use building for 10 years. And one more forecast what you have made is either the building whichever you have bought would become of $0 value after 10 years. That means the scrap value would be zero, or you think that the asset which you bought for 10 lakh, okay, let me say like $1 million is going to fetch you just $10,000, almost all a scrap. Okay, so you can estimate that. Depreciable amount or depreciable base. So depreciable amount is nothing but the asset which you have shown in the balance sheet. Okay, is nothing but the one on which you are going to calculate the depreciation, and that depreciable amount is nothing but the assets value which you are showing in the asset side of balance sheet or the cost of the asset. Okay. So I would write the formula for this. So let me write the formula for this. Just a second. I'll just open one more slide. So here they are using a terminology called depreciable base or depreciable amount. So I'll write it here. Depreciable amount is nothing but original cost of asset minus scrap value. This is called depreciable amount. OK, so all of you can make a note of this. Now coming to the methods of depreciation, and I have already explained you, land never depreciates. OK. As now I have already explained you what methods are in usage in US GAAP. So straight line method has come into picture. So what is the formula for finding out depreciation in straight line method? If they give you depreciation rate that it is 10%, then you can directly apply this rate on the asset value. Suppose your asset is of 1 lakh. So 10% of this would be what? Your depreciation amount, that is 10,000 rupees or dollars, whatever you want to say. But if they don't give you any rate, then what is the way of calculating the depreciation amount? Original cost of asset minus scrap value, or you can say depreciable base or depreciable amount divided by estimated useful life of asset. So suppose my original cost is 1 lakh. My scrap value is, for example, 0. So, and my estimated useful life is 10 years. So my annual depreciation or periodic depreciation would be 10,000. Or if I have scrap value, so 1 lakh less 10,000 divided by 10. So 90,000 divided by 10 is 9,000. That is my depreciable. That is my periodic depreciation amount. OK, so please make a note of this. I'm moving to the next one.
Can you please scroll up to the formula one? The depreciation amount formula.
Hello. Yes. Okay. So now coming to double declining method. Double declining method is nothing but straight line method into 2. Straight line method depreciation into 2. That means whatever the amount you're getting for straight line method, if you multiply that with 2, it is nothing but double declining method. Okay. So why we use, see what is the concept or what we say logic behind using different methods for depreciation? Very simple. What happens is, suppose you have a car, okay, and that car you are using for personal purpose, personal use, and there's a car you're using for taxi purpose. Okay. So now I would ask you a question. See, for this car which you're using for personal use, what method would be more justified, and the car which you're using for taxi purpose, which method would be more justified or suitable? So I say here straight line method, here double declining method. But why? Why? So let me tell you that what is the here straight line method depreciation. Not if suppose straight line method rate 10%. Suppose the rate is 10%, I would multiply that with 2 and that becomes 20%. So 20% I would reduce from the asset value. Okay. So why are we using these two different methods? See, if you use car for personal purpose, you would be using very less. Okay. So I can use straight line method for depreciation. It's more justified. But if you take a car for taxi purpose, you would be using the car like the maximum usage of the car would be during the initial or beginning days. Am I right? Please tell me yes or no. The maximum
Yes.
usage of the car would be during the initial days when the car is new. Why? Because it can give you it is very efficient during the early days. But with the passage of time, what happens? The car efficiency decreases. Okay. And like the efficiency goes on reducing every with passage of every year. Am I right? After 10 years, the car is not having that efficient use. You cannot like efficiently use that car after 10 years. The car's usage would not be up to the mark. Okay. But with the car which you're using for personal use, in the 10th year also it can give you a very comfortable like service. Am I right or wrong? Please tell me yes or no.
Yes. Yes.
Yeah, so the person who is using car for taxi would be using it to the maximum levels during the initial days or during the initial period. Okay, because he would be comfortable driving it. Then afterwards he wants to replace it. Car which is used for personal use can be used for longer period of time. So straight line is more justified here. So the logic behind that is that. So now double declining method. So there's an example here. If the useful life of asset is 10 years, take a depreciation charge each year equal to 20% of the asset's book value at the beginning of the year. So 20% is nothing but twice of 10%, which happens to be the rate under straight line method. So the conclusion is double declining method formula is nothing but straight line method rate, whatever the rate you are using under straight line method, suppose it is 10%, you are multiplying it with 2. That means you are making it double. So 20%. That is nothing but that is called as double declining rate. So double declining rate, suppose it is 20% into asset value, suppose it is 1 lakh, okay, would give you the depreciation as 20,000. And in straight line method, the depreciation would have been how much? 10,000. Okay, 10% of 1 lakh. So if I reduce, you see the difference. 1 lakh minus 10,000 is 90,000 here, and 1 lakh minus 20,000 is how much? 80,000 here. Okay, so there we can see with double declining method, the asset got depreciated by a higher amount. There's a question in front of you. Can you work out this question, please? I'm waiting. Okay. So let me explain you this question. A company buys an asset costing 1 lakh. Oh, sorry. A company buys an asset costing $1 lakh that has an estimated salvage value of $10,000. Estimated useful life is 4 years. So first we would calculate, see their rate of depreciation like 10%, 20% is not given. So when rate is not given, you need to calculate the depreciation amount. Okay, what is going to be? So what is the method of calculating the depreciation amount? Yes.
1 lakh on $1 lakh we have to do depreciation.
Okay. See, let us go with the question what they're saying. So this is the asset value. This is the salvage value. The life is 4 years. Let us say what they're saying. Depreciable base is 90,000, of course. That is 1 lakh asset value minus the salvage value. There is a given a 4-year useful life. Okay. So like 25% every year would be depreciated. Am I right? This is the rate. But I'm not saying about amount. This is the rate. Since the asset life is 4 years, so if you divide those 4 years, like if you just see the entire lifetime is of 4 years, correct? So each year how much? So till 4 years it will be depreciated 100%. Correct or wrong? Please tell me. The asset would be depreciated 100%. 100% or how much? The asset would be depreciated 100% or how much? Yes. It would not be depreciated 100%. Why? Because you have a scrap value of 10,000. Okay. So the estimation here, what they are making is 25% every year would be depreciated. Let's go with their method. Okay. So the annual depreciation recorded under straight line method would be 25% of the depreciable base. And under double declining method, it would be what? Double of 25%. Okay. So the depreciation charge for year one must be calculated before calculating Okay, let's go ahead what they're doing. So assets book value is 1 lakh. 50%, that is as per the double declining method, it would be depreciated 50% in the first year. That is double of 25% straight line rate. So 50,000 depreciation removed from 1 lakh, correct? Now the asset is of how much value now? 50,000, correct or wrong? Now 50,000 ka 50% would be 25,000, correct?
Yes, sir.
Every year 50% you should remove now. Now it has become 25,000. Now 25,000 ka 50%. It becomes 12,500. Till here everything is all right. Yes.
Yes, sir.
Now last year what happens? Last year the 12,500 asset would be depreciated only by 2,500. Why? Because last year the scrap value is how much?
10,000.
This much you are getting now. So the depreciation is 2,500.
Yes,
so your depreciation amounts are 50, 25, 12, 5 and 25. Okay. That's it. Just have a look through this question. I'll move forward. Okay. Let's move forward. If you are done with this, we'll move forward actually. Yeah. So the next method is sum of the years digit method. I will solve a question for you and you kind of try at home this question as a homework. I will do a question for you. Okay. See, what is this sum of the years digit method all about? This is a form of accelerated depreciation charge that is based on the assumption that the productivity of the asset decreases with the passage of time. Okay, so what happens here is under sum of the years digit method, we would calculate a fraction. I would come to that fraction afterwards, the calculation part and everything. But like what happens is sum of the years digit method attempts to charge a higher depreciation expense in early years of the useful life of asset and lower expense in later years. Okay, because the asset is more productive during the early years and less productive during the what later years, correct? So this is the main point. So what happens here, please see. Sum of the year digit method attempts to charge a higher depreciation expense in early years of the useful life of the asset and a lower expense in later years. Okay, because the asset is more productive in early years. Okay, and less in later years. And also the asset loses productive efficiency in early years of its economic life. That means more of the productive efficiency is kind of like lost during the early years. Why? Because we will be using the asset to its maximum extent during the early years. Okay. Now, what is the formula to find out the depreciation expense? So this is the formula under sum of the years digit method. Depreciation expense is equal to remaining. Please write down, very important. Remaining useful life of the asset. Okay. Remaining useful life of the asset divided by sum of the years digits into depreciable cost. Please write down this one formula. I'm not making you to mug up any of these formulas. I don't want to mug up this all whatever they are showing. Please, all these things I can directly explain it from the textbook and tell, but no, I want to justify the thing. So write down this one and we'll do a question right now. So now let's do a question.
Sir, can you scroll up for a minute?
Yeah,
We
sure,
are
sure,
writing
sure,
the-
sure. Yeah. If done, shall we move forward?
Yes, sir. Yes, sir.
Okay, okay. Let's solve a question from this. So let's do a question. Cost of machine is equal to $250,000. Expected useful life of machine 5 years. Salvage value $25,000. We are doing sum of the years digit method. So what are we doing here? We will take 1, 2, 3, 4, 5, 5 years. Okay. Depreciable base is nothing but 2,50,000 minus 25,000. 2,25,000 you'd get. That is your depreciable base. You can write down. And the remaining life, we'll make a column of remaining life of machine. So what is the remaining life of machine for first year? 5 years. Correct or wrong? Please tell me yes or no.
Yes, sir.
For 2 years,
Yes,
4
sir.
years. For 3 years, 3
4
years.
years.
For 4 years, 2 years. For
2
5
years.
years, 1 year. Correct?
Yes, sir.
Now depreciation fraction. So 5 years. Now this is like 15. Okay. Sum of the digits. Sum of the digits. Sum of the years digit. So this is year. So sum of the years is nothing but this. So now what we will do? 5 out of 15, 4 out of 15, 3 out of 15. That means this here the depreciation would be maximum for this asset for the 5 years. Am I right or wrong? Please tell me. Yes, Jabbar,
Yes,
and
sir.
yes, Smriti and Zarina, what? Is this right that this would be having a highest depreciation during the early years, correct?
Yes, sir.
Yes.
Depreciation expense. So 2,25,000 into 5 by 15 would be how much? 75,000, 60,000, 45,000, 30,000, 15,000. It will be 2,25,000. And the book value would be what? 2,25,000 minus 170 minus 75 is 175, correct? Yes. Is it 175 or what? See, 2,25,000 minus 75 is how much?
150.
150,000.
1,50,000. So 2,25,000. Okay, like book value would be 2,50,000, na? So 2,50,000 minus 75 is how much? This is depreciable base. Yeah, 1,00,000. This is depreciable base. Don't deduct from this. From asset cost, you should deduct. So again, next year on 1,75,000 minus 60, 1,15,000. So like that 70 again, then 70 minus 30 is 40, 40 minus 15 is 25. Like that it goes. Okay. So please make a note of this, and then we will move forward. Then what you can do is you can do this question as homework. Okay. We will do this question like units of production method. Okay. So if you're done with this, let's go for this question. Units of production method. So units of production method is again a very simple method. So what is this actually? Like original cost of asset minus salvage value. Okay. Into estimated number of units to be produced by asset over. So if I have to say a easy one, see, listen to this. See, a new piece of equipment is purchased for this much. This is the original cost. And like the salvage value is 2 lakhs. So original cost minus salvage value. And what we are doing is divided by how much units they have to produce? 10 lakhs. Correct or wrong? Yes. Hello.
Yes, sir.
Yeah. So what we do is, see, they have got this answer now. I will directly get this answer. How? Original cost of asset minus salvage value into how much it has produced in the year first year. Annual production divided by total production during its lifetime. Total estimated production, correct? So now what we do is 20 lakhs minus 2 lakhs into annual production it has done is how much? 1,20,000 divided by what is its production capacity? 10 lakhs. Correct or wrong? Please tell me. Yes. So I can write production capacity or production capacity. So if you divide this, tell me what's the answer you're getting. So this becomes 18 lakhs into 1,20,000 divided by 10 lakhs. $0.12. So 18 lakhs into 0.12 is what?
2,60,000.
Dollars. Okay, this is the depreciation. So this modified accelerated cost recovery system is already completed in the investment decision. So you can just refer this. And I don't think I need to explain. Tomorrow we will start from here. Tomorrow I'm going to finish this chapter. Only just 2 to 3 pages are there. And I'm also going to finish. It seems to you as 2 to 3 pages, but impairment is a bigger concept. It would take time. So tomorrow I'll wind up this chapter and then immediately jump into this chapter. What is that? Intangible assets. OK. And if time permits, we'll try to finish this. OK. Thank you so much, all of you.